Hello and welcome to the Of Interest podcast. I'm Gareth Vaughan from interest.co.nz. The start date may have slipped, but the government is pushing ahead with launching a depositor compensation scheme. The scheme will provide protection of up to $100,000 per eligible depositor per licensed bank, building society, credit union or deposit-taking finance company in the event of deposit taker failure. Treasury and the Reserve Bank continue putting the pieces of the scheme together, with the government now saying it'll launch in mid-2025 compared to prior estimates of firstly earlier this year and then October this year. To discuss the Depositor Guarantee Scheme, I'm joined by Geof Mortlock. Geof is an international financial regulatory consultant who undertakes work for the International Monetary Fund and World Bank, specialising in financial system stability, resolution of bank failures, deposit insurance and related matters. Hi, Geof, and welcome back to the Of Interest podcast.
Hi there, Gareth, and good to be with you.
Look, we previously had you on as a guest to discuss what was then the fledgling deposit insurance scheme back in August 2022, but we have a lot more detail now about how it's shaping up. So it's a good time to have you back and talk further about this issue. So firstly, Treasury recently issued a consultation paper in which they said Finance Minister Nicola Willis had decided the depositor compensation scheme would be built up, or the fund that supports it would be built up over 20 years to a size equivalent to 0.8% of protected deposits, or roughly about $1 billion. Now, given the most recent Reserve Bank figures show household deposits of $243.708 billion, $1 billion doesn't sound like a lot. So I guess the first question here is this enough? And what would setting it at a significantly bigger size mean practically?
Well, it is low. If you look internationally at what other countries have done with their deposit insurance schemes, the deposit insurance fund that they have typically has a target level of between about 1 and 4% of protected deposits. It varies a lot country to country. And in some jurisdictions where there is a higher probability of bank failure, then they'll have a higher level to reflect the greater risk. Now, the risk of a bank failure or a non-bank deposit taker failure in this jurisdiction is relatively low based on historical data. Let's hope it remains so. So that would point to having a somewhat lower fund than some other countries would have, but it is low. It is lower than what the IMF or the World Bank would normally recommend. And the other thing that stands out is the length of time that they are taking to build it up to that target level, 20 years. The normal recommendation that I make when I go into various countries for the IMF or the World Bank is if you're starting a new deposit insurance scheme, that you allow about 10 years from the beginning to reach the target level. So they're allowing double that time. That is quite a long time. And it means, I think, that they would be relying quite heavily on the supplementary funding line from central government, because it is quite likely in that window of time and maybe beyond that the deposit insurance fund would not be sufficient should there be any significant failures.
So what do you mean by supplementary funding?
Supplementary funding is where, if the deposit insurance scheme itself hasn't got sufficient funds at the time of a failure, or say multiple failures, to make the payouts to insured depositors, then it can draw on a fund provided by the government, like an overdraft facility, to make the payments that are needed to repay insured depositors, or to enable insured deposits to be transferred to another viable bank. And it borrows for that to the extent that it hasn't got sufficient funds, and then it subsequently repays that amount back to the government when it recovers funds from the balance sheet of the failed entity.
Okay. In that 20-year time frame during which the fund is going to be built up, if there is a bank or a non-bank deposit taker failure during that period, then I guess, are we talking about existing tools being used, such as possibly the Reserve Bank's open bank resolution policy, or I guess government bailouts?
I think if it is a small non-bank deposit taker that fails, so one of the smaller entities, then the deposit insurance scheme is most likely the route that they would take. They would pay out insured depositors. They would then probably proceed to wind up that entity, or maybe facilitate a merger with a larger bank. And the deposit insurance scheme would probably be sufficient for that purpose. Typically, deposit insurance around the world is used for small bank failures, not large ones. Now, if it was a large bank that were to fail, so anything with, I don't know, total assets of above, say, 30 or 40 billion, then the deposit insurance scheme is clearly not sufficient. And they would need to look at alternative mechanisms to resolve that failing bank. And that does raise the issue, as you point out, of the so-called open bank resolution, OBR, scheme that they have.
Yeah, I mean, that 1 billion size, so even when the 20-year point is reached and it's built up to that size, as you point out, that's still pretty small in the context of New Zealand's bigger banks. So I guess that I think it's interesting for people to understand that. So, I mean, in the context of New Zealand, obviously, as you say, the non-bank deposit takers, the depositor compensation scheme could be used there, maybe for one of the smaller banks, but anything from our probably medium-sized to large banks, or a systemic issue, obviously, it's not going to be sufficient. So I just wonder, I mean, what does happen in other countries when there is a major bank failure and there's a deposit guarantee scheme in place, or systemic issues? And I mean, how would that play out? I guess the point I'm coming to is, is there actually, given the scale of this or lack thereof, is it actually really worth having this depositor compensation scheme?
I think it's definitely worth having, Gareth, because there are quite a sizable number of small deposit takers out there, and at some stage, one of them is going to fail. Hopefully, not for a long time, but statistically, if you look around the world, there are occasional bank failures, and most of them tend to be small. If you look at the United States, for example, the FDIC, the deposit insurance scheme there, has been used multiple times in most years to resolve a small failing bank. And given that with a small failing bank, you're not looking at systemic instability. Your focus is not, therefore, to maintain continuity of critical banking functions. Your focus is likely to be to pay out insured depositors, or enable the fund to transfer insured deposit accounts to another bigger, healthy bank, and then basically wind up the rest of that small bank, and no systemic damage is done. So for a small deposit taker or a medium-sized one, I think having a deposit insurance scheme is really important. And I think it helps in two ways. It lowers the risk of interbank contagion, where if we had a fragile banking system, there was concern that you may have multiple small entities failing. And we've had experience of that in the past, with the finance companies failing 10 years or so ago, 45 of them, I think it was. Then having deposit insurance reduces the risk of what we call interbank contagion, where one failure can trigger multiple runs across the banking system. So deposit insurance helps to reduce that. And secondly, it helps to reduce the risk for the taxpayer because it means that there is a dedicated fund paid in by deposit takers and therefore reduces the need for government funding. But for a large bank failure, it is not going to be sufficient. And if you look around the world, for a large bank failure, deposit insurance funds are not typically used anyway.
So if we did have, and hopefully we won't, but if we did have a large bank failure in New Zealand, I mean, do we come back to the OBR, the Open Bank Resolution Policy, or government bailouts? Just for listeners, if you don't know what the Open Bank Resolution Policy is, this is a Reserve Bank policy, and the idea is that OBR would enable authorities to reopen a failed bank the next day under statutory management and avoid the adverse consequences wherein the bank's critical functions are abruptly disrupted. The basic idea is to provide customers access to their accounts as swiftly as possible so they can carry on making and receiving payments. Under OBR, a portion of creditors' claims may be frozen to absorb losses, but shareholders would be the first to lose their investment in the bank when a failure occurs, and only when the amount of shareholders' funds are insufficient to absorb losses would some portion of creditors, like depositors' funds, be frozen. So is this still going to be the key tool we should be looking at for any potential large bank failure? Or just a bailout? Or, I mean, if you look at obviously a big international issue a year or so ago was in Switzerland with UBS and Credit Suisse, and the authorities forced a merger on those two behemoth banks. Could that be another alternative in New Zealand in the case of a big bank failure?
Well, I should say, first of all, that initially I was reasonably supportive of OBR in the early days. And in fact, in 1990, it was I who came up with the notion of bail-in for New Zealand because I put that option on the table with the failure of DFC in 1989-1990. We decided instead to go with a different option. But the problem...
You were at the Reserve Bank at the time.
I was, yes,
Yep.
And I was in charge of the resolution process for DFC from 1989 through to the early 90s. And one of the options that I came up with and put to the statutory manager was a form of bail-in. I didn't call it open bank resolution, but it involved applying a haircut to unsecured creditors. First of all, subordinated creditors, then progressively more senior unsecured creditors, including retail deposits, which DFC had, to facilitate loss absorption and recapitalisation of DFC. In the end, we went with a different option, and I think that was the right decision. Now, if you look at what has the rest of the world done, and what does the international standard promulgated by the Financial Stability Board advocate, it does advocate for what we call a bail-in tool, where you can apply a haircut to unsecured creditors, including potentially uninsured deposits, to facilitate the absorption of losses and to enable the recapitalisation of a large bank, or facilitating, as you pointed out, its sale to or merger with another larger and healthy bank. The difference, though, between what the RBNZ has developed, OBR, and what the rest of the world is doing is that they have focused on a mechanism that would haircut deposit liabilities, uninsured deposit liabilities, whereas in most jurisdictions, what has happened is that they have created a tranche of what is called bail-in debt, total loss-absorbing instruments beyond capital. And it is that would be bailed in. And I'm not aware of any serious central bank in the world that would take the step of bailing in uninsured deposit liabilities for fear that it would trigger a run on other banks who are reliant on large amounts of non-insured deposits. The bulk of their deposit book is often uninsured. It's wholesale funding. And that is exactly why we saw in the United States in early 2023 their response to Silicon Valley Bank and two other banks at the time running losses and it needed to be resolved. And what the government did, was effectively to put in place a guarantee of wholesale funding because they were very worried that if losses were borne by wholesale depositors, there would be a run on many other banks in the United States, triggering potentially a very serious systemic risk. That is the risk that the Reserve Bank of New Zealand is running with their OBR policy.
That's interesting. So are you basically questioning whether they would actually use it if it was a major bank failure? I mean, perhaps on a smaller bank they might?
On a small bank, I don't think it would be needed because I think deposit insurance would do the trick. And you wouldn't be looking for a small bank to keep it going because it's not systemically significant enough. You'd be looking to, I think, do a payout of insured deposits, maybe sell viable loans to banks willing to buy them, and then the rest would go into an orderly winding up. So one would be talking about how would one deal with a larger bank. So the four major banks and two or three others in this country. And at the moment, the Reserve Bank is really only talking about OBR, and I think it would be potentially catastrophic for them to use it. I don't think a Minister of Finance would actually allow them to. And bear in mind, the power does not lie with the Reserve Bank. It lies with the Minister of Finance. And I'm sure a minister would say, well, look, you might be recommending that, Mr. Raw, but we're not going to implement it. Instead, we'll look at another option. And other options could be, for example, a bail-in of some non-deposit unsecured liabilities, all subordinated debt, obviously bailed in, maybe some other senior unsecured instruments like bonds bailed in, but not deposits, maybe with some government funding, which is then fully recovered in net present value terms, so no moral hazard. In the case of any of the four major banks, they're Australian-owned, and I think any sensible resolution would be one that would involve cross-border coordination with the Australian authorities. And that's the other concern I have, is that the RBNZ has not sufficiently developed, in a cooperative way, a trans-Tasman coordinated approach. And certainly when I worked at APRA, we were wanting that kind of approach, and there was a resistance on the part of the RBNZ to coming to the party on a sensible accommodation.
So looking at what will actually be covered by the depositor compensation scheme, I mean, obviously term deposits, savings accounts, current accounts would be. What else could we expect the scheme to cover?
Well, a deposit insurance scheme typically would cover an on-call account, a transaction account, term deposits, and it will be designed in such a way that will demarcate clearly, if it's done properly, between a financial instrument that is covered and that bears a kind of like a trademark, if you like, or branding that makes it clear that yes, it is covered by the deposit insurance scheme, and those instruments that are not covered. So conventional deposits, whether they're on-call, transaction facilities, or term deposits, whether they're PI form deposits or non-PI, would all be covered by the deposit insurance scheme. Any other instrument, such as a bond, for example, is not covered by that scheme. And it should be clear with the way banks and non-bank deposit takers market their financial instruments as to whether or not the instrument is covered by the scheme. That's really important.
In a consultation paper, the Reserve Bank raised the idea of revolving credit facilities and potentially credit cards as well. Is that normal overseas?
No, credit cards definitely not. I mean, that's a credit instrument. You could have a debit card where there's a balance that you have with the bank, a positive balance, and that would represent a liability of the bank. But normally, those kinds of instruments are not covered by deposit insurance schemes. Revolving facilities, if you've got a facility whereby you at times have a positive balance with the bank, then in some jurisdictions the deposit insurance scheme will cover that kind of fund. It'll be, if it's categorized basically as a deposit, so it's a revolving facility, and if at the time of failure you had a positive balance with the bank in that account, then very often a deposit insurance scheme would cover that. But it depends on the parameters of the scheme.
Okay. You were talking there about, I guess, sort of trademark issues. So the Reserve Bank is developing a trademark for products covered by the depositor compensation scheme. So a brand and identity so people can easily identify what's covered by the scheme. I'm just wondering whether there could be any circumstances, and I should say that other countries do this already. The other countries that have depositor compensation schemes in place have this sort of trademark in place. I'm just wondering, though, whether this creates any danger that products that aren't covered, there could in effect be a run on some of them once the scheme comes in place.
Maybe could be a risk of that, but I think most of the liquid funding that a deposit taker has, so the funding in the form of on-call instruments, for example, would be in the form of deposits that would be covered by the scheme. If they had other funding of a non-deposit nature not covered by the scheme, then that would most likely be in the form of a bond instrument or CP or something like that. And I don't think there'd be an expectation on the part of someone holding that instrument that they would be covered, because it wouldn't have been marketed as a deposit. So I think that branding is really important, and that deposit takers very precisely make it clear when they market any instrument as to whether it is not covered by the scheme, and that'll have to be monitored by the Reserve Bank.
So previously, you said that the $100,000 depositor payout cap will need to be increased over time. Why do you say this?
Well, because of that old devil inflation that sadly the Reserve Bank have failed to a greater degree than some central banks to tame. We've got an unacceptably high inflation rate, and some of that is due to poorly conducted monetary policy, and some of it's due to exogenous factors. Now, with inflation, even if it's at the target level, over the years, it will obviously erode the real value of any dollar. And not only that, but with nominal growth in GDP per capita, incomes are rising, hopefully somewhat above the inflation rate. And likewise, deposits will increase in nominal value over time, such that 100,000 in 2024 it might be the equivalent of, I don't know, say 120,000 in 2040 or something like that. So what I'm really saying is that they need to keep the limit at a a realistic level in relation to ensuring that there is coverage of the vast majority of retail deposits by the insurance scheme. And as time goes by with inflation and other factors, that $100,000 limit will eventually, if it's not increased, reduce the extent of coverage of the deposit scheme. So that is why it does need to be increased periodically.
The depositor compensation scheme is going to be funded by levies paid by licensed deposit takers, so the banks and the non-bank deposit takers. And money from the levies will be held in a statutory fund with a Crown backstop. The Reserve Bank has said its preferred option is to set the levies via a risk-based approach. What does that mean, and do you believe that's the best option?
I think it is the best option, so I support them on that. What it means is that a bank or a non-bank deposit taker is assessed on the basis of what is the risk profile of that entity. So what is the probability of it failing? Hopefully they're all at very low probabilities of failure, but the probability will vary depending on the bank. If it's got very good capital, if it's got a very good quality loan book, it's got strong governance, it's got really good risk management, then it would have a lower risk. Conversely, if it's got a lower capital ratio, weaker governance, maybe a higher concentration of loans in higher risk areas and so forth, it's higher risk. And you want this to be a user pays kind of framework, so that if you're a higher risk institution, quite logically and fairly, you should be paying a higher levy per dollar into that scheme, because there is a higher probability that the scheme will have to one day pay out for your institution relative to a lower risk entity. But it does mean that the Reserve Bank is going to have to be quite careful in the way it assesses risk. It'll have to be transparent in the way that is done. And that is critical, because otherwise there is the potential for a mispricing of this. So let's hope they will come up with a very transparent and rigorous, accountable framework for assessing risk.
And what impact, if any, on the interest rates paid to depositors could we expect, once these levies come in?
Well, a bank or a non-bank has a choice. They pay the levy. Now, they could absorb the cost of that into their net interest margin and not pass it on to depositors, or they could pass it on to depositors, or they could pass it on to lenders by increasing the lending rates, or they could do a bit of both. And each bank will be different. It will depend on their circumstances, on their profitability, and so forth. Some might say, look, it's a fairly small level of basis point per unit of dollar of our deposits. We'll just absorb it. Our profitability is such that we won't pass it on. We won't reduce interest rates on deposits. We won't increase lending rates. Others, whose profitability might be somewhat lower, might decide to pass it on, maybe lower the rate of interest on deposits. So, for example, if you're a small non-bank deposit taker and you're paying a reasonably high risk premium in that levy because you're higher risk, you might decide, okay, we are going to reduce the interest rate that we set on deposits to compensate for the fact that we are paying this levy. But what they can do, therefore, is lower the interest costs that they're paying and therefore come out reasonably neutral. And what they could do in their marketing is to say, look, guys, yes, it's a lower interest rate than we were offering last year, but this is basically a zero default instrument. So if you're a small deposit taker, at the moment you're paying well above what a bank is paying to get deposits. And that's because you're much higher risk than a large bank. Well, under this scheme, any deposit with a small non-bank deposit taker will have the same effectively zero default risk as a deposit with a large bank. So there is scope, therefore, for non-bank deposit takers to take advantage of that in their marketing in, I hope, a responsible way. And that, again, will have to be monitored.
The government's decided not to adopt depositor preference. Can you just explain what depositor preference is and whether you agree with that decision?
Well, depositor preference is where, in the winding up of a failed bank, deposit liabilities rank above other senior unsecured liabilities in that winding up. So they get first bite of the cherry before otherwise equal ranking unsecured creditors get paid. And if you look at Australia, they've had depositor preference for many, many decades. The United States, likewise, and various other countries are moving to that system as well. In some cases, it is a two-tiered preference where there's a first preference for deposits covered by the deposit insurance scheme, and that benefits the deposit insurer because they get first bite of the cherry and their probability of loss is therefore much lower in terms of recovering value. And then the second preference kicks in for uninsured deposits. In other jurisdictions, in Australia is one, and the United States is another, they simply have a single preference, so they don't differentiate between insured and uninsured deposits. I'm in favour of depositor preference, and I therefore think the government has made a mistake in not going down that route. And I say that because of two things. One, depositor preference helps to reduce the risk of runs on banks. If it is well known that deposit liabilities rank ahead of other senior unsecured claimants, then all else being equal, one would expect wholesale depositors to be less inclined to run in a banking crisis than they otherwise would be. And the second reason is that it actually facilitates bail-in, because you can say with credibility that yes, we're going to do a bail-in for this large bank failure, but uninsured deposit liabilities are unlikely to be part of that bail-in because they have a preferential ranking. And at the moment, you've got, I think, the worst of worlds, because you've got the Reserve Bank with this OBR, but the only jurisdiction I can think of outside of some dubious ones which would apply a haircut to deposit liabilities, and no depositor preference. So if you're a wholesale depositor in a bank and the banking system is looking shaky, and you know that the OBR is out there and could be triggered, what are you going to do? I think you're going to do a preemptive run. And what would that do? That would almost certainly mean that the governor, joined by the Minister of Finance, would have to say, A, we're not doing OBR, and B, we are putting in place a temporary guarantee of all wholesale deposits. Just the opposite of what you would want to have to do. So I think it is a foolish policy, OBR, and made even more foolish by the absence of depositor preference.
Okay, so the Reserve Bank will administer the scheme, the depositor compensation scheme, and it will be able to invest funds that aren't required for expenditure. And there's also going to be a Crown backstop in place. I mean, the Crown, does the Crown backstop, is that effectively there in case extra money is needed and therefore the government steps in? And what's your take on the RBNZ? I mean, is the Reserve Bank the right entity to administer this?
The Crown backstop is basically there in the event that the deposit insurance scheme does not have enough funds to make payouts. So it's what we talked about before, that they're setting it the target fund at I think too low a level, and they're allowing too long a time, 20 years, to get there when it should be done in I think roughly half that time. And so the backstop is there to enable the fund to meet its commitments if the accumulated fund is not sufficient. And I think that's sensible. That is exactly what a lot of schemes do around the world, and this is what we recommend when I do IMF work around the world. It's exactly what I recommend. But I think they have miscalibrated the size of the deposit insurance fund. It's too low, it should be higher, and they should be building it at a faster pace. Now, should the Reserve Bank administer the scheme? In some jurisdictions, you'll have a separate agency. But I think for this country, it makes sense that it be the Reserve Bank because they are the resolution authority. And so I think having them as the administrator of the scheme is cost effective. But I would recommend it be done through a subsidiary of the Reserve Bank and not the Reserve Bank itself. They have that option under the law, and I think that would be the better path because it would create greater separation between the fund and the scheme administration from the Reserve Bank itself. And it would also reduce conflicts of interest because what you always need to ensure with a deposit insurance scheme is that the funds in that scheme are used only for the purpose of reimbursing depositors and not for wider resolution purposes. And if it's controlled by effectively the board of the Reserve Bank, they will be conflicted by different objectives, and I would worry about that, especially with, sadly, the lack of quality on the board as it currently stands.
Well, look, Geof, thanks so much for that. We'll watch with interest over coming months as the final details of the depositor compensation scheme are announced. That is Geof Mortlock, who is an international financial regulatory consultant who undertakes work for the International Monetary Fund and World Bank, specialising in financial system stability, resolution of bank failures, deposit insurance and related matters. And I'm Gareth Vaughan at interest.co.nz with another episode of our Of Interest podcast.